If you're not using some of these tax strategies that I'm about to mention today, you're putting yourself at a great disadvantage from the person to your left and right, or even your competition. My name is Joshua with Thompson Tax Group, and I got some great year end tax strategies that you can use today. Let's get right into it. So, when doing a year end tax planning or year end tax strategies, one of the biggest things you want to think about and look into is what changed throughout the year. And this year with COVID, we had quite a number of things change that you could take advantage of. The first one is the employee retention credit. Another big one is the RMD suspension, where if you're older and you're supposed to be taking a required minimum distribution this year, that is suspended and you're not required to take one in 2020. Also, the 10% withdrawal penalty is waived for the majority of retirement accounts as long as you're a qualified individual. Another big thing is NOLs, net operating losses carryback. Now, with the passing of the Tax Cut and Jobs Act, you weren't able to take that back anymore. You can only take it forward. But due to COVID, with the Secures Act, you can now take that back 2 years depending on what years we're looking at. Another big one is charitable donations. Charitable donations, a big thing that changed this upcoming year, is that you could start taking a $300 deduction even if you're not itemizing for cash charitable contributions. Now it's $300 per return, but that's $300 more that you could take that you may have not been taking in the past. Some ways to implement this is know the tax law or some changes that were made, and know if you qualify for all those changes. Not everyone does. And to contact your tax professional or the owner or the individual taking care of and managing your retirement account to make sure that they included themselves in that account as well, or include themselves in the changes, because not everyone adopted some of those changes. And then the last thing is, when you're doing charitable contributions, is to make sure you're contributing it to a 501c. If you don't know what a 501c is, basically is a charitable organization that you can find on the IRS's website, making sure that they qualify for that status. So if you go on to one of those websites like Kickstarter and you donate to someone $50, $100, if they're not a 501c, that donation is technically not tax deductible. Second big strategy I usually recommend for clients that are doing year-end tax planning is really timing your income and timing your expenses. And what I mean by that is really when it comes down to your stocks, you want to time when you want to sell those stocks, because there's long-term and short-term gains are taxed a little bit differently. And a lot of times, depending on your income, some of it is completely not taxable at all. You can check out our capital gains video that talks a little bit more about that in depth. Another big one is delaying your business income as much as possible, which is, if possible, don't have your income come in until January. And I'll talk a little bit more about that when we get to the how to implement these strategies. Another one would be prepaying expenses. If possible, pay your expenses earlier so that way you can take those deductions now. Now we're looking at it, we want to determine, okay, we got these strategies, how do we go about it, and how do we implement it? For the buying and selling stocks, the best way to implement that is to go log on to your online brokerage and purchase the stock you want to buy, or sell a position that you have and then rebuy that position if you want to use a capital gains this year. That's a strategy that you can have. Or also talk to your brokers that handles your stock transactions or handles managing your money. Another big one is to hold your invoices until January 1st. That's how you can delay your income when possible, especially if you're on the cash method. And if you invoice on January 1st, now that gives you the entire next year to plan for that income and use strategies to reduce your tax as much as possible. But when you invoice them at the end of December, a lot of times there's not much you can do because time is already running out. The last big one is to, like I was saying, prepay your expenses. Contact some of your vendors, anyone that you usually have normal expenses with, and try to prepay maybe a month in advance expenses so you can take that deduction this year, especially if you have the extra cash. A big one is maybe prepay a rent for 1 year, or prepay some insurance as well. Those are little items here and there that can help out this year with this upcoming tax debt that you may have. The third big piece of advice I'd like to give when doing year-end tax strategies is depreciation and expense method. And a lot of people don't know too much about this, but you could pick a depreciation method that allows you to take a bigger deduction for your assets, your capital assets now rather than later, especially if you need the deductions earlier. For example, we had a business that we were working with that they went out and bought two major assets or vehicles for their business. The vehicles had specific specifications that allowed them to take the entire deduction in the current year, which ended up resulting in a $60,000 deduction in year one rather than maybe a $5,000 deduction this year. And really, they only paid roughly about $8,000 to $10,000 up front to get that deduction. Another big one that a lot of people don't know about is determining if you want to take the mileage deduction or the actual deduction when it comes down to vehicles. And what I mean by that, with the mileage, it's usually either 58 cents times per mile you drive, or 57 cents and a half, or 54 cents, depending on the year. It changes every year. And what you could do is, as long as you keep track of your mileage, you could take that percentage or that cent base times by the amount of miles you've driven that year and use that as a deduction. And it's 9 times out of 10 where the mileage deduction is more of a deduction than actual expenses. But know that you can't take both. Now, how do we implement these? Now, you can elect to take Section 179 bonus depreciation as well on certain assets that you have that qualify for it. You can talk more with your tax professional about that, and they can let you know what assets you may have that allow you to take benefit of Section 179 or bonus depreciation. What you also want to do for the mileage versus actual expense, you want to keep track of your mileage, meaning you want a mileage log. You don't have to necessarily have a piece of paper and write everything down, but you do want to have an app or something keeping track of everything. One big one I see a lot of clients use is Mile IQ, that allows you to track what business expenses that you may have, where are you going, how far it was. So at the end of the year, you give that to your tax professional and you can get a larger auto deduction in often cases. So my final thing I have for you guys is to remember your retirement accounts. You'd be amazed of how many individuals I sit down with during tax time that completely forgot that they stopped contributions to their retirement account, and that's 3%, 6%, or even more of free money that you could be getting every year from your employer that's matching your contribution. So don't forget you have retirement accounts and to contribute to them to get that benefit moving forward, because at the end of the year you don't get that anymore. Now, some ways to implement that: you want to contact your account holder or even your employer, your employee relationship department, and make sure that they have your contributions scheduled and they're continuing and you're at least contributing up into the match. And just remember, by December 31st, you can no longer make those contributions in the majority of accounts. Now, if you own a business, many times you can take those contributions and your deadline moves to April 15th of the next year to still get benefit for contributing to last year's accounts. A lot of times you'll see that with IRAs as well, but I always recommend, if you're getting a match, get it in before December 31st. All right, lastly, you'll kind of see here, it's one thing I'm talking about, the biggest things that I've been seeing that are saving the most money for most individuals. I've been seeing with the clients that I work with that the COVID change has been saving them some good money. The timing strategy, it's a nice strategy to have in your arsenal, and it saves you some good money as well. But the biggest one is your expense method. Know your depreciation. If you're doing a cost segregation, if you know what that is, if you're investing in real estate, it's a way to really bring a big deduction in the current year to reduce your tax liability as much as possible. And lastly, the retirement accounts, it's a nice addition to have on there, and it does save you some tax dollars become April 15th. Hopefully you don't wait till April 15th to get your taxes done, but it's one thing that helps out to save money on your income taxes. So that kind of wraps it up, you guys. If you have any other questions, feel free to reach out to me. Here's my information on the screen. Once again, it's Joshua at ThompsonTaxGroup.com. Check out our website at ThompsonTaxGroup.com. Then you can also check us out on Instagram, Facebook. We're also in a lot of Facebook groups for veterans as well, just helping out, giving some information out there. So if you guys have any questions, feel free to reach out to me. Once again, our number here is 805-364-0908. You'll get directly to me if you guys have any questions. Feel free to reach out. But other than that, you guys have a good one, and I'll see you guys till next time.